It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome, welcome. It's the last weekend in June. Very exciting. It's Jill on Money. This is our first show where we can really make the big announcement, Mark. It's time. Jill on Money has its first baby and mascot. Mark's a daddy. Mark's a daddy, gang. How about it? A baby boy. Am I allowed to say his name or not? Theo. Baby Theo. Jill on Money. He'll be on the air very shortly. Well, he'll be in the studio shortly. I can't wait. You're going to have to bring him in here. Everybody in the radio division wants to meet him. So that's good. Hey, this is Jill on Money, and we are broadcasting live from the Capital One Bank studios, and we are delighted that you are joining us. And it's exciting because guess what? In just a matter of days, we will be celebrating what? Not just the birth of Mark's baby boy, but the longest expansion on record. 121 consecutive months of growth. We just beat out the tech boom. How about that? Now, while this is the longest expansion on record, it is definitely not the strongest. The strongest expansion on record was the 60s, coincidentally, when one of your hosts was born. 1961 to 1969, 52% growth in GDP. The tech boom, 42% growth in GDP. The 80s, the Gordon Gekko years, 38% growth. And here now, in this current expansion, we only have grown by 25%. Not sure why, but we have made progress. Balance sheets look better. You probably feel a little bit wealthier. That's good. About half of the country says, according to a Bankrate study, that they have either seen their financial conditions worsen in the last 10 years or just stay the same. So that's a bummer. Hopefully, as things do continue to improve, job growth continues, wage growth expands, more and more people feel secure. All right, if you've got a question, don't forget, give us a call. Ask Jill at jillonmoney.com. That's what Nate did. He's up first. Nate is calling from Texas. Hi, Nate.
Good morning, Jill. How are you doing today?
Great.
So the reason I'm calling in, I'm getting ready to retire from the Army, and I'm getting ready to enter the civilian workforce. For the past 16 years, I've been investing in the TSP with the Army. And my question is should I plan on rolling my TSP over into a civilian 401k, or should I start a new 401k with whatever company decides to pick me up?
Okay, that's a great question. Tell me a little bit more about yourself. How old are you, Nate?
I am turning 40 this year.
Oh, my gosh. That's amazing. It's like you're going to probably end up having like 3 different careers in your life. How much money is in the TSP right now?
So the TSP has about $200,000.
Okay. And is this the only money you have saved for retirement? Did you do a Roth IRA in addition or not?
So I actually planned this out a little bit. My total value I have a brokerage account or a taxable account that has about $250.
Mm-hmm.
I have a Roth IRA with about $110. My wife has a Roth IRA with $110. Mm-hmm. We have our savings, which has about $100, and then my I guess you can call my investment account has about $30, and then I have my house. Mm-hmm. So yeah, that's about my total worth.
Just I want to make sure I heard that. You said you have a brokerage account with $250, just a plain old brokerage account, not a retirement account, right?
Right.
Okay, and how do you manage that money? Are you doing that yourself? Are you rolling the dice a little bit, or are you hiring someone to do that for you?
So the taxable account is managed by USAA.
Mm-hmm.
It's a managed brokerage account. It's very low fees. I think it's like 0.03%.
Oh, that's good.
I got grandfathered in about 10 years ago.
Oh, that's great. Okay, good. Perfect. All right. And what about the Roth? Also USAA?
Also USAA, both of them.
Okay, great. And same deal, manage it at 30 basis points at 0.3%?
Yes.
Okay, great. So let's think about kind of your choices. The thrift savings plan is actually a very good plan. It used to be sort of like this, like, well, you got one or two choices. Like you can have a black car or you can have a white car. But
Exactly.
they've added more choices. The cost of the investments in TSP, in the thrift savings plan, are really cheap. So I actually think I would keep the money in there. Because rolling it over, what I'm fearful of is that you don't really know, and maybe this would change if we found out where you were going next. But wherever you go next, I have a feeling the cost of investing inside of the 401k plan would likely be higher than what you're getting in the TSP. And for what? It's really the same stuff. So my inclination is to wait. If you get a new job and you find out, well, you know what? It's awesome. They have a 401k and it's all index funds with a low-cost provider, and it's really awesome. Maybe you would do that. But that would be kind of the big choice. Otherwise, your other option would be to roll it out of the TSP into a rollover IRA account, and you could do that anywhere. If you're grandfathered in for USAA, is that also for new money or just existing money?
So since I have kept the same account for over 10 years, so they're keeping me at the same fees. As long as I don't start a new account, I'm fine.
Oh, so you know what? That's kind of a funky thing because we would have to start a new account to do this because we would have to open a rollover IRA. So I think that the choice is really, I'm leaning towards keep it in the thrift savings plan unless you go to a new employer that has an obviously cheaper investment structure. So now I'm going to ask you a total separate question. What are you going to do next? Do you know?
So that's a really good question. I'm trying to get into the technology sector, trying to start a brand new career, get to do something I've always wanted to do. And so it's I'm kind of fishing right now, I guess is the best way to describe it.
And when are you going to actually retire?
It'll be in September.
And you'll have a pension, right?
Yes.
Okay. So you're really in great shape. You've saved, 1, 2, 3, 4, 5, 6, like you have almost like $750,000. How much did you make when you were in the Army? What's your highest pay? Just out of curiosity.
The highest pay that I've earned, if you include all of our compensation and health and all that, our total compensation, I think it was about $106,000.
106. And does your wife work?
No, she does not now.
So you have saved all of this money making $100,000 a year.
Oh no, far less than that. Actually, I started when I was a specialist, and our paycheck at that time for 2 weeks was about $600 every 2 weeks. You are
an inspiration. Mark is going to be giving you the 5-star General Award of like a leader of retirement. I mean, you've done a phenomenal job. So congratulations. Keep us posted. If you get a new job and you're like wondering, hey, should I roll it or not? You want to give us a call back, please feel free to do so. We'll get back to more of your questions in just a minute. In the break time, why don't you go to JillOnMoney.com? You can read about the longest but not strongest expansion on record. Go to JillOnMoney.com, and all you have to do at the top is click on Read, and that's where the blog post sits. Okay, we'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back. It's Jill on Money. It is the last weekend of June, and maybe you're taking a nice extended break. Hopefully you're taking all of this next coming week off. That's what I suggest you do. It's a dead week. Come on. You can always send us an email, whether you're on vacation or not. Ask Jill at JillOnMoney.com. Let's go out to Steve. He's calling from Michigan.
Hi, Jill. Yeah, I'm trying to determine the best course of action for where I am. I'm retired from teaching a few years back, so I've got a little over $500,000 in traditional IRAs that I accumulated over my working years. I read a book entitled The IRA Transformation Plan, your step-by-step guide to a tax-free retirement. And so in consultation with the people who promote that book and their and their advising business, what I pulled away from that, and in order to save taxes as I withdraw from retirement funds and so forth, it seems like there's a number of things they were suggesting I do. One is to move those monies into a Roth account, which, of course, you pay taxes on as I do that. And the reason for that is just not to have that taxable income, but also I guess there's a 6-year or so window from which to do that under the Trump tax cuts.
Right.
That's advantageous. So, and then secondly, maybe is it wiser to go to like a Vanguard ETF, which has much lower fees? I'm kind of in the process of seeing if it's better to get those lower fees than pay the little bit higher fees on the mutual funds that I currently have in T. Rowe Price. And then thirdly, something that they're offering, and this is a paid thing, to get some monies into what they call a guaranteed insurance contract.
Ooh.
Whereby I guess the idea is that is also a tax-free type of instrument, and to get the death benefit as low as possible and the earnings as high as possible. That's like a third idea.
Okay. So let me go back a second here.
Sure.
Okay. How old are you now?
61 in a couple weeks.
Okay. And you have a pension because you said you're a retired teacher?
Yeah, I've got a nice, well, it's not huge, but it certainly pays the basics. So I'm not needing to tap into this retirement money
Okay,
maybe.
So let me just ask, so how much do you receive as a monthly pension benefit?
Yeah, let's see, it's about $2,800 a month.
Okay, great. And you have your medical covered through the teacher's pension as well?
Yeah, it's got a high deductible, but it's nice to have, yes.
Yeah, great. Okay. Are you married? Single?
Yes.
Okay.
Married.
And what about your spouse? Work, not work? What's the situation?
Yeah, she too is retired. Her pension is very minimal. It's more like $300 a month.
Okay. And she's also early 60s?
Yes.
Okay, great. Kids?
Out of the house.
Nice. Well done, my friend.
Yeah.
And tell me a little bit more about the other. So you have $500,000 in a traditional IRA. Is that you and your wife? And is that the combined?
That's basically me. She's probably got about $70,000, but hers is all Roth, I believe.
Oh, okay, great.
Yeah. Mm-hmm.
How about non-retirement assets? What have you guys accumulated?
Well, the home's paid off, a couple cars. I got 2 rental properties that are paid off. Those are bringing me, after I have to pay the taxes, maybe $1,000 each per month.
Oh, so $2,000 a month in rental income.
Yeah.
Okay, that's great. And if you looked at the just like a safe emergency account, so you have no retirement, you have no assets outside of retirement that are invested, but do you have like a bank account or CDs just in case fund, an emergency reserve?
Yeah, our checkings and savings would count for that. I mean, there's a fair amount of money in those.
About how much?
Oh,
I know, I'm a pain in the neck.
$50,000. Maybe.
Okay, perfect, great. But nothing else. There's no like stock account or anything that's floating around, right?
Correct.
Okay, great. Now, if I look at call it the $3,100 between you and your wife a month, covers what your needs are right now?
Yes.
And what happens to the extra $2,000 a month that's coming in from the rental properties?
Pretty much just sticking it aside. It's in the bank.
But it doesn't. You're not spending that money, or you're not using. You're not earmarking that for anything, right?
Correct. We might take a nice trip once a year and pull off of that, but basically that's just growing on its own.
Okay. So I think that what we're talking about here is this idea that if you were to convert your $500,000 into a Roth, that you could potentially, not definitely, but potentially save tax money in the future. However, you guys don't have the money set aside that would allow you to pay the taxes that are due, right? Because I really don't want you to spend that $50,000 emergency reserve fund on conversion costs because you still need it, right? You absolutely positively need this account just in case, right?
Correct. Uh-huh.
Okay. So right now you guys are in the 12% tax bracket, because you make under $79,000 a year.
Yes.
Okay. So the idea of converting part of this, the thesis behind it is, why don't you convert the money while you're still in the 12% tax bracket? That's good, but I wouldn't do it right now. I would wait so that you build up the money that you would need to pay for the conversion, meaning to pay the tax that's due. And the idea would be, I'm paying the money at 12%, while 12% is the bracket I'm still in case 10 years from now our tax brackets rise, which is an absolute possibility. No one knows, but I think that that's a good guess. So I think that the idea to move to a Roth slowly over the next 5 or 6 years is fine. But remember, number one, you only want to convert as much money that's going to keep you in the 12% tax bracket. So whatever you convert, it's got to be under that, it's about $79,000. And then you have to make sure that you have the money to pay the tax that's due. And if in 1 year where you just we get maybe if you've sold a property or you've popped up into the next tax bracket for some reason, I don't know why, but let's just pretend you did, then maybe that's a year where you'd say, okay, well, I'll pay some of this at 22%. But I think that I think it's good to have some money that has been converted, and your wife, if she already has 70, and that you had, let's say, another 100 or 150 by the time the sunset of the tax code takes place over the next 6 years, I think that's just fine. So now, question number 2, you ready?
Mm-hmm.
Should you move to a Vanguard ETF environment? I think the answer is, what are you currently invested in?
It's currently quite widely diversified.
In what? In other words, where is it held?
Current funds are at T. Rowe Price and mutual funds.
Yeah, but those are cheap mutual funds, aren't they?
Yeah. As I looked at it, a lot of them are around 0.7%, and then as I looked at the ETF, some of those are like 0.06 or 7.
Yeah, so there's no reason to go to Vanguard. I mean, Vanguard's great, but T. Rowe Price is great. Stay where you are. And if you want to choose cheaper funds, you can always just stick to index funds. That's the cheapest funds, right? So I think that's fine. And then the GIC, forget about it. Take that off the table.
Oh, okay.
Don't do that. Otherwise, I think it sounds like you're in fantastic shape.
Yeah, thank God we are, I think.
Yeah. I mean, it just shows you can have 2 people who've worked really hard. You probably didn't make a ton of money, but you were teachers and you were part of a pension system. That's amazing. So I think that it's great that you're managing this. It's great that you've decided to grab it. When someone tries to sell you something, a product, a service, be a little skeptical. Give us a call, but absolutely positively stick to your guns, because I think you don't need any sort of guaranteed income account. You don't need any sort of insurance product. Just keep it simple. You absolutely are in great shape. Don't worry. Okay, we'll get back to more of your questions. Hey, have you subscribed to our podcast? It's a sister broadcast. It's called Jill on Money. You can get it on Apple, Stitcher, Radio.com, Google Play, anywhere else you find your favorite podcasts. We'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back. It's Jill on Money, and I am Jill Schlesinger. And it is always delightful to have you stick with us throughout the hour. Hey, remember, we mentioned so many different resources, and I invite you to send us an email if you come across some helpful resources. Just shoot us a note. It's askjill@jillonmoney.com, and Mark will check it out, make sure it's not something weird, like someone's personal monetization of your financial life, and we'll pop it into the resource section of the website, Jill on Money. So the email address, askjill@jillonmoney.com. If you, again, run across something interesting, let's figure out together how we can help each other. Okay? All right, here is, my voice just went up. I guess I had a little Peter Brady there. Here is a message from Jennifer, who found our channel, meaning the YouTube channel, Mark. Oh my gosh, I love that. And Jennifer says, I've been loving all of your advice. I wanted to get your take on some next steps for me and my husband. I'm 30, my husband's 36. We both have stable full-time jobs, no kids, no plans to have any. Together, we make around $100,000 a year. We increased our retirement savings this year. I'm putting 20% into my 401k. Fantastic. She makes $42,000 a year. Husband is putting in $400 a month into a state retirement fund. We have decided, with your help, to open and fully fund Roth IRAs as of this year. But I'm not sure where to open them, what kinds of funds to use. We are finally at the point where we're not saving for any big purchases. I'm just not sure where to put our extra money every month. I know a good problem to have. And so let's see. Combined, they've got $63,000 in retirements, $20,000 emergency reserve, $300,000 house, $150,000 outstanding, 3.875. All great. Okay. Now, let's talk about where to put this money. If you want to go full on do it yourself, right? Meaning that you will invest your Roth IRA money, you'll invest any money yourself. The best way to do that is with index funds. And the places where you can get access to index funds are the places that you have heard of. And those are the big investment houses like Vanguard, T. Rowe Price, Fidelity, TD Ameritrade, Schwab. All of those places offer cheap index funds. Okay, now, presuming that you want to do it yourself, then you would just do some sort of a allocation, some sort of risk questionnaire, but you're young, and especially for the retirement money, you're going to, basically have more money in stocks than bonds and cash. You might want to pick 2 or 3 different funds, maybe a U.S. stock fund, an international stock fund, and again, these are index funds, and then maybe an intermediate term bond fund. Okay? Now, you do that. Well, I'm going to make up an allocation for you. You don't have to do this. I'm just making this up for you. But, I'm 30 years old. It's a retirement account. So what would I do? Maybe I would have 60% in some, broad U.S. index fund, 60. Maybe another 15% in an international, and then another 15%, 20%, whatever's left over in an intermediate term bond fund. Done. That's it. If you actually want a little bit of help, you want to step up a tiny bit, what you would do is you would choose an online platform that would, for a quarter to maybe 0.3%, maybe 0.4%, offer you some advice, but also manage your money for you. Those services include the Vanguard Personal Service Advisor, the Schwab Intelligent Portfolio, or Betterment, which is a company that used to sponsor my podcast but doesn't. I always like to say that. Do you think I have to keep saying that or not, Mark? I'm done now. They didn't renew. Goodbye. But they're good companies, so I should say. So, but those are like good choices, and that I think is kind of where you want to be. Jennifer writes, other part of her question is her company's employee stock purchase program, which she's been enrolled in at the max. She's about $36,000 in stock. I feel like it's too much based on her holdings overall. I'd like to start selling some of this over the years. I want to contribute. I want to continue to contribute as I do now. When I do sell, only the gains go towards my taxable income for the year. Company is stable. I've made some good gains over the years. I've enjoyed the dividends. When I think about the amount of money you would want in a stock purchase plan or in just your company stock, which a lot of firms will match their 401k contributions in company stock. When I think about that, what I believe is kind of like the best way to keep a tight lid on the risk is to say, whatever your overall investment is, let's say you had $100,000 in your 401k. I would never have more than 5% in my company stock. Now, for you, obviously, just given the amount of money you have and having a bunch of money in your company stock, you may have a little bit more in company stock than you'd like. So I don't think it's a bad idea to sell some of it. You should check with your company exactly how the sale of that stock would be treated for income tax purposes, and also whether they could potentially withhold the money on your behalf. So that's it, Jennifer. I hope you're well. Here is a question from Christine. I enjoy watching you in the morning news, and I love the daily updates. I'm looking to purchase a new car. Is there a better month to car shop? Hey, you know what the best month to car shop is, Mark? End of the year. It's always the end of the month, the days at the end of the month. Also, literally the last 2-3 days of the year, because a lot of dealerships have monthly quotas they have to meet in terms of just units sold, quarterly and annual. So that is that's kind of how I look at it, Christine. I bought my car one year. I remember I was literally wiring the money on December 31st, the morning of. And when the dealer asked me a question that seemed to indicate he was going to just not honor what he told me, I was like, okay, forget it. I canceled the wire. And no. Wanted that unit. Anyway, good luck, Christine. It's Jill on Money. We'll shop for anything with you guys. Just give us a holler. The email address, askjill@jillonmoney.com. And when we come back, more of your great questions.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money. And if you've got a financial question, we'd love to hear from you. You can send us an email, askjill@jillonmoney.com. You can also head over to our website, jillonmoney.com, and there we have a Contact Us button. So that's fun. Also, while you're on the website, a couple things that you could do. Sign up for our free weekly newsletter. Mark, we've cracked 20,000 subscribers. So join the thousands of people who are getting this great content that we curate every week. It's great. We do the work, so you don't have to worry about it. I was just saying to Mark, it's so hard to keep up with everything. So exhausting. So sign up for our free weekly newsletter. And now you can also buy the book, The Dumb Things Smart People Do With Their Money. 13 Ways to Right Your Financial Wrongs. We'd love for you to buy that book. And, it's an easy summer read. Get it before the 4th of July. Hurry up. All right, just dovetailing on the email we just did previously, here's a question about robo-advisors with CFP support. Listen to a recent podcast, How to Preserve Assets, and we are in a similar situation, so it was very informative. Our question is whether or not it makes sense for us to engage a hybrid robo-advisor. Guys, let me just define that for you. The robo-advisor is essentially the automatic online trading platforms, and many of them have now added advice as a component. So, again, we'll talk about this, but that's really what we're talking about. We're talking about everything online. Some of these organizations will allow you to even have a call with an advisor. So that's kind of cool. Okay, so let me get back to Jess here. We are considering the Vanguard flagship services. It's a flat 0.3% plus about 0.1% for investment fees for the exchange-traded funds. So let's think of it as 0.40 or 40 basis points. Okay, the other choice, Schwab's Premium Advisory, one-time $300 planning fee, $30 a month for unlimited access to CFPs. Okay, now back to Jess. He says, I'm 66. I retired last year. I've always managed our money. My wife is 62. She works part-time. She's never really been interested in money management. This is a major reason why I'm looking at a hybrid robo having some personal contact, input, and guidance. We have Social Security and a joint annuity that provides $68,000 a year. We'll be drawing 25 to 30 grand from our assets. We've got $2.2 million. I'm looking at a 30% stock, 60% bond portfolio for stability and safety. In your view, do such hybrid robo-advisor services add sufficient value? Even if my wife managed money, we would still consider them for consistency and to allow us more time to enjoy retirement. They're solid and trustworthy. Appreciate your time and input. Thank you very much, Jess. Here I'm thinking two things. One is, if Jess dropped dead tomorrow, God forbid, how would his wife feel about having the robo-advisor? Is that enough? Now, this is one of those cases where, I think if it were just two people who were sort of similarly interested and knowledgeable about managing investments, that might be something. I would say, first of all, you can't go wrong with either one. All right. So the Schwab or the Vanguard. Do we have any idea, Mark, like does one versus the, Vanguard's been around a little bit longer. Schwab just introduced this year. Maybe I would lean slightly towards Vanguard. I don't know. To me, it looks like the Schwab would be cheaper for you over the long term. But here's one last thing to remember. It is different doing business with a robo than it would be doing business with a human being. And in this case, maybe you could do a robo, but also I think that just given that your goal here is about hopefully helping your wife get a little bit more familiar with the process of managing money and taking control of this, perhaps in this case, I might say, how about talking to a person who is a fee-only advisor or a CFP or a CPA who's got that PFS designation, talking to someone like that, it would cost more, but I wonder if maybe it's really this. Maybe it's you talk to somebody like that, you pay up for that advice, you establish a relationship, you talk to that person once a year, you keep managing the money, but you establish a relationship with someone with whom your wife would feel comfortable if you were not managing the money. So I think that that's what I would do. I would start thinking about it. It's a more expensive way to go, but maybe I wonder if maybe you could just pay a flat fee for the hour, pay, couple $3,000 for someone to look at this for one time and then get some updates. I don't know. That might be the way that I would look at it. Okay. Here is a note from Wendy about paying for college. My question: how and where can parents and adult students find financial support for students who will enroll in graduate school and beyond? My daughter is working and paying off her undergraduate and college graduate loans. She's been accepted, wishes to complete her PhD in the next 3 years. Hey, would Kelly be somebody for that, Mark? I don't know. You might want to try going to money-mentor.com, money-mentor.com. Have her do that. See if she might get some help from someone on the grad school side. But grad school, by the way, very different animal. And also, I think especially if you're getting a PhD, there's more flexibility in getting money from the institutions. So let me know what you find out from money-mentor.com. It's Jill on Money. And if you've got a financial question, give us a shout. It's Ask Jill at jillonmoney.com. Hop onto the website. You can read the stuff that I've been writing, listen to old shows, and watch television segments where my hair looks different in every segment. We'll be right back. You're back. It's Jill on Money. Very exciting. Let's go and do quick emails before we head to a break between hours. So this is from Linda. How would you invest $230,000, which is what Linda will be receiving from the sale of a rental property? Here's her goal: safety and to pass along the money tax-free to my 2 children. Linda is 72 and retired, and she does not need this money to live on. Her income is about $100,000 a year. It's pension and Social Security. And she wants this investment, this $230,000, not to generate more taxable income. Her only debt is the $250,000 that she has outstanding on her house, which is in the form of a home equity line of credit. Should I gift my children money or pay off my mortgage? Her mortgage is 4.3%. So listen, if you're thinking that essentially that you want safety and security, right, and you don't want to create a tax problem, this $230,000 right in and of itself, by putting it in a safe account, would create a tax liability. Alternatively, it might not if you put it in a municipal bond fund, a short-term municipal bond fund, but there's some risk in that. And frankly, if you have the opportunity to pay off your mortgage, that's locking in a 4.3% return. Maybe it's a little bit less after you get the tax deduction with no risk. So, presuming that you don't need any money in your emergency reserve fund, that's already set. I would say that paying off the mortgage is a good opportunity. If you want to gift your kids some of the money, it depends what they need. Like, do they need the money right now? Maybe what you do is you give each of your kids $15,000. That's your gift. You can do that and take the rest of the money and pay down the mortgage. That may be something to consider. So I would, sort of in the big picture, make sure you've got enough money in emergency reserve. See if your kids need $15,000 each right now. There's no tax associated with that. And if you got those other two things, go ahead and pay down that mortgage, 4.3%. Not bad. All right, that's the end of Hour 1. We have been broadcasting live from the Capital One Bank studios here in New York. When we return, we are going to get more of your great questions. During the break, head over to JillOnMoney.com and check out our resource tab. Got a lot of good stuff there. All right, Jill on Money. We'll be right back.
It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Okay, we are back. It's hour number 2 here at Jill on Money, where we are broadcasting live from the Policy Genius studios. Policy Genius is the easy way to compare and buy insurance. Go to policygenius.com. Our guest this hour is really interesting. His name is Erin Dignan, and he has written a book called Brave New Work. Now, he's an angel investor, but he also has a company that helps transform and coach different types of companies, large and small. His firm is, I think, really interested in figuring out how to kind of rip away what's not working in the job space and figure out what is working. I found him really interesting. I think that the idea of prioritizing people who are more adaptive and autonomous over the people who are checking all the boxes, that's going to be a next step in the workforce. The book is called Brave New Work, and we're going to dive in. We'll also talk about his company, which is called The Ready. So here is our interview with Erin Dignan. All right, so what does your company do right now?
So The Ready helps organizations, particularly very large ones around the world, get away from bureaucracy, the kind of inhuman, hierarchical way of working that kind of drags it all out of us, and move to something more adaptive and human.
How do you do that in a big, nasty, we're broadcasting live from one of them, CBS Corporation. How do you do that?
It's interesting. Of course, the mindset most of us have for change is that you go in from the top and you get some big dynamic leader and you tell everybody it's all going to be different now, and there's one grand gesture, one new org chart pushed out in PowerPoint, and then it's done. What we've learned through years of really trial and error, honestly, trying all the different ways to crack this nut, is it's a lot about actually just inviting teams at every level to solve their own problems. So we actually go to teams and say, what's stopping you from doing the best work of your life? And when they tell us the answer, we say, great, what are you going to do about that?
Do you have to get buy-in from the top to allow that to occur?
You do. You need support, at least within the domain where you're doing the work. So if it's inside a function or a P&L or a location, we've done factories, we've done all sorts of different places. Once you have a ring around that where the power holders say, okay, we're sick of the old way, let's try a new, then that's really all they have to do is make space, essentially.
Let's say I have a friend who works at a large media corporation.
Sure, a friend.
Let's just say I have that friend. And that friend maybe works in this one division which pumps out content all the time, this news organization. Let's say that friend is me. Let's look at that as like a model. Here you walked into this building. Let me ask you a question. Have you ever been here before?
No, I haven't.
What was your impression as you walked in?
There's a lot of gray. There's a lot of hallways. I didn't see a lot of people on my way back because they're all squirreled away.
Do you get a sort of a first impression, like a hot take on an organization when you see the physical space?
Yeah, because it's funny. One of the things I talk about in the book is that we all sort of live in this operating system, which is a set of assumptions and practices and principles that kind of make up culture. And of course, space is a huge decision in that operating system. So what does it look like? What does it feel like? Do people sit next to each other? Do different kinds of roles and functions sit with each other? And so, yeah, when I walk into a place, I do get a really quick sense of like, okay, what's going on?
Yeah,
here?
right. You get like a little like a vibe.
Yeah,
I know.
for sure.
I do too. So I was down in some other media companies, Yahoo, offices. I mean, look, the place could be falling apart. I don't care. Verizon wrote a big check, and that's fine. But it is so nice to see people just open. Mm-hmm. It's bright. Mm-hmm. It felt collaborative. It could be baloney. I don't know. Maybe it is.
Right.
But I'm just saying that the feel was so different, and it was so palpable because I came from the CBS Broadcast Center, and
Straight
I went
there,
right.
Contrast.
It was weird. I was asking them about, how do you incorporate the video versus the written, and how do you do this, that, and it seemed a bit more collaborative. What happens if there are silos? So I'll give you, like here, we have CBS, we're broadcasting in the back of the radio division.
Sure.
But, I do work in the television division. There's network, there's affiliates. How do you bring them together if they have all been traditionally siloed in the past?
Yeah. Certainly the first way to do that is to start with an experiment. So we don't want to just, tear up the sheet and try to do something at scale right away because that never works. I mean, something like 80% of all large change management fails. So that's a challenge. So we often start with an experiment, and the experiment might be, let's do something cross-functional to break the silo around this project or this venture or this vehicle, and do that for a few months to see what do we learn, right? What works, what doesn't work, what breaks, what rules, policies, boundaries, rhythms have to change to make that possible. And if we get great success with that, then we can replicate it. There's one company that I studied in the book in China called Haier. They're the world's largest and fastest growing appliance manufacturer. They took 60,000 people who were working in silos, blew it up into 2,000 autonomous teams in a single year. And,
oh my God!
And completely took ripped the Band-Aid off and said, all right, you're all now P&Ls. You all figured out for yourselves your customer service, your delivery. They had some central shared services to help them do it. But for the most part, you had literally thousands of teams running around trying to do their work. And what's amazing is it's totally successful.
What's amazing about that story also is that it's so counterintuitive to consider that a Chinese company, which is like the planned society, has moved in this direction.
Yeah. I think what's interesting about what's happening globally with this sort of new ways of working phenomenon is that we're seeing it happen in almost every country. So almost everywhere you look, there's a huge what they call corporate liberation renaissance in France happening right now. There's a lot going on, obviously, in the Scandinavian countries. China, the thing about China is there's a little bit of a pragmatism there. Like, does it work? Then we'll do it.
So when you go into a business that is seeking your guidance, and then we're going to get to the book also because why you read the book, but I'm just wondering, where do you find the pressure point? Where does the pushback come from?
I feel like there are two kinds of pushback, one more subtle and one more vocal. The vocal one is we don't have time. We're all so busy. We're back to back. It's one project to the next, one meeting to the next. I mean, I had a client that had 45 hours per week of meetings on average.
Stop it.
No, I'm dead serious. And so there's a little bit of like, we can't make time to fix it. And I always go back to the old adage, if I had 5 minutes to cut down a tree, I'd spend 3 sharpening my axe. We don't spend any time sharpening the axe. So if the meeting isn't serving us, no one ever says, should we change this? Like, should we get rid of this Monday meeting or tweak it? Or what are we missing here? We just barrel through, and we're sort of taught to keep our heads down. So that's the first kind of resistance, is everyone's really excited after the first, TED Talk, and let's all go do it. And then, week 2, I'm like, all right, let's start our retrospective on Friday. Oh, well, we can't make
meetings.
it. Yeah, exactly. We got to hit the quarter. So that's one, which I understand and empathize with, but it's critical. And then the more subtle one actually has to do with ego and identity.
Oh, yeah. Tell me about that.
If I'm a leader, if I'm a founder, if I'm an executive, and now you're telling me that the way to get what I want, which is resilience and speed and adaptivity and growth, is that I have to give up power, I have to share power, and I have to distribute authority, and I have to leave space and not be a hero, who am I? Right? Why am I important? What happens to my identity and my purpose and my sense of self? And I have to trade one kind of control for another and one kind of power for another. And for some people, that gap, that bridge to sort of the new identity as space holder and as kind of gardener rather than commander, that's a hard one.
We'll get back to our interview with Erin Dignan in just a second. Hey, during the break, why don't you go to our website? It's JillOnMoney.com. You can read, listen, watch. You can buy my book, The Dumb Things Smart People Do With Their Money. You can also sign up for our free weekly newsletter. So much to do and such a short break. But get going. Go to JillOnMoney.com. We'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money. This is the program that takes the mystery out of your financial life. Yeah. Okay. We're going to get back to our interview with Erin Dignan right now. Erin wrote a book called Brave New Work. And he asked this really interesting question. What's stopping us from doing the best work of our lives? And his thesis is it is the way we work. Bureaucracy, hierarchy, compliance, all the things that slow us down. And what he says make us feel less human. Erin basically thinks that the organizations are broken. And sometimes you find out that organizations are broken from the people who are doing all the work. But what about the rank and file? How can we, the small little people in these big behemoth corporations, you write about this, what we can do on the ground level now?
What constantly surprises me is we'll go into teams, particularly teams at the edge. I like to refer to it as the edge rather than the bottom. And I'll just ask them, what's stopping you? What's holding you back? What are your tensions? We have a bunch of tools we use to help them generate those tensions, and then they'll outline them. And I'll say, great, which of these can you do something about? And the first reaction is none. But then as we peel back the onion, even for 15 minutes, it's like, oh, well, we can change the way we meet and we can change the way we communicate with each other and we could ask for this. And suddenly 80% of what's on the table, they're like, maybe we could chip away at that and start to move the needle. So part of it is just claiming your power and taking responsibility for your way of working, right? I mean, there's a lot of control there, even within the constrained kind of workflow that we all have.
What do you think the elements are to creating these independent teams that function within these large organizations? What are the characteristics that you have seen make them more successful?
Yeah, well, I think at a principles level, it's really about 3, right? Transparency is 1. So really having a high flow of information. We all know what's going on. We all know what we're trying to do. We can see progress, work in progress. There's not a lot of this kind of theater that goes on of like, I'm going to hide it and then I'm do the big presentation, or you don't know what my division's doing because it's part of, we're going to be successful and you're not. So high transparency, high autonomy. So this idea that, each of us can be the director of our own effort and can choose what we work on and can choose when we work on it and can choose where we work on it and all that kind of stuff, which is hard for certain places to get on board with. And then the last one is really participation, or consent is another way to say it. If you talk to folks in the Netherlands where sociocracy, a way of working that really focuses on consent, was born, the idea is just we don't all need to agree. We don't need consensus. We also don't need command and control. But what we do need is consent, meaning we all agree that this is how we're going to do this, or we're going to structure it this way, or this is the role, or this is how we're going to figure out who does this work. And so just by asking for consent, which is that's safe to try. I may not love it. I may not even agree, but it's safe to try. then we can kind of move forward. So autonomy, transparency, consent are really good places to start.
Look, you run your own company, and you've run your own companies,
Sure.
right? You're a serial entrepreneur.
Sure.
So talk about hierarchy, the good and the bad of hierarchy, because here's something that's kind of intriguing to me. I ran a company for a while. I was the second in control. I really didn't run the company. I was just a high producer in a
Sure.
company, and I had ownership.
Yeah.
So I didn't really want to manage. So clearly stated that I just did not like that role. But there were times where the rank and file were unhappy having to make the decision themselves. I'm like,
Sure.
just figure it out. Don't bug me. And I felt like there were times I had to jump in because that's what they wanted. Was that a failure of not having the system that was in place to give them that autonomy? Or maybe it was a failure of my business partner who's a complete maniac?
It depends, right? So one of the things we do early on with teams when they're sort of rejiggering how they work is talk about decision rights. So where does a decision live? And there's a bad habit that we have of doing like a racy chart where it's like who's responsible and accountable and informed and consulted. And it gets very messy very fast and it's impossible to hold in your head. So we just focus on where does the decision live? Does it live with an individual? Does it live with a role that's held by an individual? The way the president has an authority but not the individual? Does it live in a team? And once we know where it lives, then we know how to make it. So some decisions are best made by a team, right? They need different perspectives. They need diversity of thought and opinion. And so we need a way to make decisions as a group that's fast and efficient and effective and safe. And then if it's owned by an individual, then maybe it's something that they can just decide on their own, or maybe it's the kind of decision that, for example, at a company like Hire or Bertzorg or Favi, comes with an advice process. So you have the right to make the decision, but you have to seek the counsel of people that are going to be effective
Advise
first.
and consent.
Exactly,
I like that.
right. So that's one of the things that might have been unclear there is like, why are we freaked out about this decision? Maybe because we don't know where it lives, and if we don't know where it lives, we automatically assume that it lives at the top.
Right, with the lunatic in charge. Okay, I think I'm past my statute of limitations on everything.
Sure.
Anyway, when you go into different organizations, you go into mature, you go into tech, you go into international. Are there certain ones that are just harder than others for you? Because listen, I come from financial services, the
Right.
big, boring old farts of the universe, right?
Oh, yeah.
Is that a harder environment for you to enter as a change agent?
It sort of yes and no. So we do a lot with financial services, actually. But what's fascinating about it is they're the most in pain, but they're also the most constrained. So they actually call a lot, and they have a desire, and there's a need, and there's a kind of a passion for figuring out better ways to do this. But at the same time, they're regulated or they're in a high-risk space. I mean, we've worked in, aviation. We've worked in spaces in healthcare where it's like you can't screw up or something really bad can happen. What's challenging about those environments is that 1% of decisions that actually falls into that bucket becomes 100% when there's sort of a learned helplessness, right? Because the regulator said no to one thing, because we have to be compliant with 10 things, all things are not possible now. So it's easier to just say no to everything.
Right.
And it's easier to create a culture of risk aversion that sort of wraps around the handle. So yeah, in a way, those are some of the most challenging industries to work in. Not because it's not possible to do this work, because there are cases like Bertzorg in healthcare, right, that do really do it well. But the challenge is actually the mindset. It's the way people have become identified with that category and that regulation and that compliance that actually means we have an extra 6 months of work to do to get everybody sort of unwound.
So if you have an organization like, let's say, Facebook,
Yeah.
was it flawed to begin with that you have this one guy who has all the voting rights, who has really no accountability? I mean, is that just basically setting someone up to fail to some extent? Because no one can fire this dude. No one
Right.
gets that. Like,
Right.
you could be shamed, but there's no accountability. Is that a problem with a system design, or is that just an individual weird company issue?
No, I think it's quite common now and actually being replicated. I think the problem is actually the intersection between the organizational OS at the Facebook level and the economic OS. Founders like that, one of the reasons that they try to hold that those sort of super voting rights is that they're afraid of the way the public market can really ruin a business. And the fact of the matter is that the public market has now gone from something where we would hold a stock for 8 years in 1960 to an average of 5 days today. There's a lot of short-term trading. There's a lot of volatility trading. There's a lot of automated trading. people are hoping for rapid growth, quarterly outcomes, things that are not necessarily long-term goals.
Right, so don't go public then. Screw you, don't take the money.
Well, and I think that's something that a lot of startups are figuring out with things like Indie VC and other funding sources is maybe we don't want to go public, or maybe we go the route of, Eric Ries is creating a long-term stock exchange where the longer you hold a stock, the more vote you have.
Mm-hmm.
I think if those mechanisms really were brought to scale, then organizations like Facebook would have a third option, right? Option A is you have this super power holder. Option B is you go to a public market that's going to ultimately destabilize the vision and its greed for short-term outcomes.
Sounds like, by the way, that the executive folks were pretty hand in hand with that greed factor, no?
Possibly, yeah. I mean, it certainly infects the mindset if you're already part of it, which they are, right?
Exactly.
I mean, they're already part of that system.
Okay, now talk about the third way.
Yeah,
Sorry.
the third way is that you have a more distributed ownership within the company. Maybe not full cooperative, but you have a lot more employee ownership and a lot more steering and participation and consent, right? And you have a different funding source. You've gone public on a long-term stock exchange. Maybe you're a public benefit corporation that can put purpose ahead of profit when it makes sense. These are just little balancing factors that I think ultimately change the dynamic of, this thing that sort of is addicted to its own growth and success into something that's a little bit more socially positive. So we are seeing organizations start to move in that direction, and it's promising.
We'll have more of our interview with Erin Dignan in just a moment. Hey, if you've got a financial question, we want to hear from you. Send us an email. Ask Jill at jillonmoney.com. We'll be right back.
.401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You're back. It's Jill on Money. Yes, that's me, Jill. Mark's running the show. Sleep-deprived Mark running the show. He's doing all right. He's good. Hey, let's get back to our interview with Erin Dignan because I always like to know what's the story behind the story. So let's find out a little bit more about Erin Dignan. Now, what makes you so good at this? Like, what's your background? Who are you, man?
Yeah, that's a good question. My background is really just about following the most interesting question, right? So I came out of school where I was studying.
Where'd you grow up?
I grew up in Colorado.
That's why you're so nice.
Is that why?
Everyone from Colorado is so nice. Did you grow up near a city or outside?
I did, yeah, near Denver. Went to school in Boulder, all that stuff.
You were a party boy then, huh?
I was actually not. I was kind of a nerd.
You were a nerd at a party school.
Yes.
What's that like?
It's isolating.
Oh, poor you.
But I got a lot of reading done.
So you went to college
Boulder.
and then you graduated, and what'd you do?
I didn't graduate, actually.
You blew out?
Yeah. So I started a company my senior year because I had spent the last year reading about the psychology of brands and cults. So what makes us have irrational connections to systems, to communities, to things that we identify with, and got so obsessed with that and would so not shut up about it that people started to hire me to do little workshops around their brands and things that they were launching. So I ended up starting a company that my choices were go to finals or go to Coke headquarters. So I went to Coca-Cola, much to my parents' chagrin, and now I'm 3 credits shy of a psychology degree.
Dude, come on, you got to get the degree though.
I feel like now I'm just waiting for the honorary.
No, because that doesn't count. Just bang out 3 credits. It'll be fun for you.
I'd rather do another book, honestly. It's that.
Maybe you
agonizing.
should. Oh my God, you're nuts. Okay, so you became like this marketing guru. Essentially, right?
Yeah, spending time thinking about that. And what I noticed was, we were talking about brands. What I noticed were all the brands that were shaping culture were suddenly technology brands, like Facebook or Google or, fill in the blank, Apple, et cetera. And I was like, wow, they are really levering on culture in ways both good and bad. I want to know more about that. So then I ended up co-founding a company with some friends that was focused on digital change. And so we started advising, huge companies like GE and American Express and the Gates Foundation on how disruptive technologies like big data or AI or robotics or 3D printing would change their world, would change the way they do what they do or change the market that they operate in. So that was the question. That became really interesting. And then 8 years into that, I was like, man, it's actually not about the technology at all. The reason these things are so confounding to us and confounding to large organizations is that we don't know how to change. We don't know how to adapt. what does adaptivity at scale look like? Does it happen? And so then I went on this walkabout looking at biomimicry and complex adaptive systems like weather and traffic and all this other thing, and started to find these organizations that were out in the wild, really fringy. No one really spent a lot of time covering them. I mean, obscure like a tomato processor in California that is where people set their own salaries and write their own job descriptions, that kind of stuff.
I like that.
And who is 10x more profitable than their category average. And finding these companies and saying, oh my gosh, there is a better way to work, and it metabolizes the technology, but it also metabolizes all this other change that we need to do, social, economical, et cetera. So then that became the thing. And then I started the Ready and started working on this book. So it's just been like a lily pad from, is that the bottom of the ice cream tub? No, there's another scoop. And, I feel like I've hit the bottom, but we'll see.
What do you think about some of these consulting companies that have come under pressure? Like the McKinsey gets the headlines, but I'm sure every single one of them has like these weird conflicts where they're asked to do they're basically asked to do work for really bad actors.
Oh, yeah.
Right? So what is the role of saying no, whether you're a law firm or you're an investment house or you are a consultant? Because I feel like that sometimes gives a weird signal to the staff of money always comes first.
Yeah, what do we care about?
Right?
What's fascinating about this is it's back to decision rights, right? So who gets to decide if we work with big pharma or tobacco or firearms or fill in the blank or some foreign, nation that we're not super psyched about? You can answer that question however you want, but you need the consent of the group. So in my firm, the way we've created a boundary around this for now at our current scale is if we can staff an entire team of people who are passionate and ready to put their heart on the line for that client, then we'll take it. And if we can't find a whole team, then that's a signal that it's not going to align with our values. If we were 10,000 people, that might not be a good enough barrier. We might have to decide that we need the support of some percentage of the population inside, or we need the consent of, a guidance board, or who knows what, right? But the idea is figure out a way to answer that question, create a decision right around that everybody consents to, and then live with the consequences.
How many people at the Ready?
I think there are about 30 right now around the world.
What do you feel like is like the optimal amount of staff that you would feel good about managing as the boss? Can Mark and I get a job? That's what I'm worried about.
Yeah, first of all, I try not to manage. So we sort of take the role of leader, boss, manager.
Who's we?
The Ready, all my partners.
No, but I mean so you are, what is your title?
So I'm the founder, but I don't have a title. We have roles that we hold. So I hold a whole bunch of different roles, including author.
Okay.
So we break the work up into roles. People hold combinations of roles, and they build a career path and a role mix. So I'm going to take on this job, job, that job, et cetera. And that's something that's done with the consent of team members on each circle. Many roles are elected roles. The second thing is that everybody at the Ready is a shareholder. So we're all partners in the entity. Not everybody has the same amount of shares, but, we basically award shares every year based on the contribution everybody makes. That's decided by everybody. So it's a sort of multivariate approach. And everybody is essentially participating through that consent principle in building the firm. So that's the way it operates.
All right. Well, I like that. That's kind of interesting
Pretty
because,
straightforward.
Yeah, I mean, the challenge is that as the founder, as things get bigger, you're then popped into roles that you may not want.
Totally.
And in fact, what you've solved for that already, which is we all have different roles.
Yeah.
And so I think that's really smart.
We worked with a nonprofit recently, actually, where the founder was saying, all the things I have to do as CEO now that we've hit this certain scale are not all that appealing to me. I like to be the spokesperson and the instigator,
the
and
visionary,
the creative
right?
director, and the visionary. And so what I think I'm going to do is bring in a new CEO or a COO. But I think maybe that might be a bad idea. And why? And just talk me out of it, basically. And my response was, you run the risk of importing with a new leader some other operating system, some other way of thinking about how to run the business. And it's very common that people bring in that bureaucracy by trying to find that, that replacement for those needs. I said, what if we just went to your leadership team, which is very capable and very strong, and just said, these are all the roles I hold right now. Which ones can you hold?
Right, because I can't do them all.
Blow the roll up.
I like that.
And so that's exactly what we did.
That's great.
Yeah.
Thanks again to Erin Dignan for being a wonderful guest. Stay tuned. We've got a little bit more for you ahead. Some of your questions. Woohoo! It's Jill on Money. Ask Jill at jillonmoney.com is our email address. We'll be right back.
401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You're back. It is Jill on Money. It's June. Are you getting ready for your vacation? Don't forget to take your vacation, ladies and gentlemen. Come on. Mark knows I love my vacation. Mark's vacation is now filled with diaper duty. And I mean D-U-T-Y. Don't want to make, right? I don't want to be brash about it, but that's about all I got for you, Mark. Sorry. All right. If you've got a financial question, give us a holler. You can reach us at askjill@jillonmoney.com. We're blowing through the emails. Here we have from Karen. My husband had an annuity when he retired through work. He rolled it over to a North American annuity about 20 years ago. Contract's almost up. Mark, I know this next sentence will shock you. It did not perform that well. Oh, my God. You're kidding. And now, writes Karen, they are trying to get us to sign another 10-year annuity with a $12,000 bonus to roll it over. Not sure where we should put it so it performs better. He's 72. It's $200,000. Okay. Karen, you said this money came from a retirement account. Therefore, I think this is either a 401, like basically it's an IRA rollover. If you look at the top of that annuity statement, does it say IRA rollover? If it does, then you have a fantastic opportunity to simply roll that money over into an IRA rollover account. Easy. And by doing so, there's no tax liability. $200,000 would flow in, and you could do anything you wanted with that money, preferably not with the help of the guy who's trying to sell you yet another annuity that will be larded up with fees. So one of the things you can do at this point is this could be a perfect opportunity to roll the money over, go to one of these online investment services like a Vanguard personal service advisor, like a Schwab Intelligent Portfolio, like a Betterment. Go through their risk questionnaire, develop a game plan, and move the money without not too much muss or fuss. So I think you should try that. He's 72. There's no reason that you should be tying this money up anymore. Definitely try to keep that fee structure nice and cheap, and I think you'll be better off. Stephanie is a county employee. She's got the benefit of receiving a pension. However, it is employee contribution, which means it's required, and my employer takes 8% of each pay period for the pension. I have no control on how it's invested. Yeah, I know. That's how pensions work. That's a municipal pension. Okay, now Stephanie says, I'm browsing the market for a new job, both within the pension system and without. How do I weigh the benefits offered when making a decision? I've heard that having a pension is one of the best things to happen. I've also heard that pensions are not what they used to be. What should I be considering when faced whether to stay in public or go to the private sector? Oh, this is too complicated. Mark, I can't answer this straight up. I really need more information, don't I? It really depends how much time do you have in the system. You know, Stephanie, if you've been working for a year and a half, then I might be bolder. But what you need to understand is that pensions are guarantees. They are good. If you are in a system that is underfunded, like you're in a state like California, New York, Connecticut, Illinois, yeah, it's risky because we don't know what's going to happen to that pension benefit. At the end of the day, what I try to say to people is this. Try to find the job where you think you have the best opportunity. You wouldn't stay in a job just for the pension. On the other hand, you might stay there if it took, let's say it's 10 years to vest in that pension and you're in year 8.5. And then I might say, hey, gut it out. Make sure you get vested. So I'd love for you to follow up with us. Give us some more details. Let's get you on the air. Let's talk about it. Let's talk about the good and the upside and downside of your current job. That, to me, would be really smart for us. Okay. Bonnie wrote about a column I published called Financial Literacy, about financial literacy weaknesses. It's so funny. Every paper has a slightly different headline. So I have no, literally have absolutely zero way to manage this. Okay. Bonnie wants to make sure that I was aware of the Magnetar Youth Investment Academy. The goal is to fill in the gap in financial literacy with lots of competitions and this, that, and the other. And it's a joint public-private initiative. So I'm going to check it out. I have no idea I don't know anything about Magnetar, except that I remember it was the name of one of those horrible CDOs that almost burned down the entire financial system. So an unfortunate name. But Mark, did you check it out or not? We're going to check it out. And if we like it, we'll put it up on the website. How about that? Seem fair? So anyway, here's another note from Ruth about the financial literacy column. As a retired high school home ec teacher for 100 years, I'm so sad that so many schools don't value a comprehensive curriculum of the old home ec, industrial arts, music, art. I live in suburban Illinois. Illinois has had a graduation requirement of consumer education. Interestingly, parents then push to have an exemption test for their own, quote, smart children who shouldn't have to, quote, waste their time, since all the topics are, quote, common sense. She's got a great emoji there. All not true, blah, blah, blah. Thank you so much for writing that. Yes, everyone, we're going to do this together. Financial literacy, talk about it, know it, live it. It's Jill on Money. We're trying to become more financially literate together. Ask Jill at jillonmoney.com. That is how you reach us. We'll be right back. You're back. It's Jill on Money. And before we close out the program, this is a great question from Linda, who wrote, what do you think about AXA Capital strategies offered through Prudential? We had a bad feeling about this when a Prudential agent is always, by the way, funny, so salesman, tried to have us change our Charles Schwab accounts to these products. We are retired. We decided not to go with it. It sounded too good to be true. He was pushing the 10% 5-year. There were no fees. He said it wasn't annuities. He said that, but it said that I think she left out a word, that it was on the printout, thank you. These are structured notes. They're incredibly complex. So what is it? It's really like a junk bond almost. It's a senior debt obligation. So it is a riskier way to invest in something that might be liquid. There are lots of different ways to buy these things. But here's the thing. These can be quite expensive. And what the problem is because they're so complex, there may be a case for it, but honestly, it doesn't seem like in your case there is a case for it. So what I would say is when you have a bad feeling like the one you had, it's an excellent idea for you to simply say, I've got a bad feeling about this. This is not good. I'm not doing this. So one of the things that I think is like a good mantra for all of us is that if you can't readily understand the product and it's filled with lots of jargon, just stop and do nothing. And I think you did the right thing. Also, these structured notes can really get you in trouble when markets move against you. And they usually promise something that's like an annuity, like downside protection with a little bit of upside growth. But honest to God, do you really need this? Probably not. Okay? So this is the most important thing. When it smells a little bit fishy, give it a big pass. Okay, this has been a wonderful show. We have been broadcasting live from the Policy Genius Studios. Policy Genius is the easy way to compare and buy insurance. Go check them out at policygenius.com. If you've got a financial question, we would love to talk to you. Send us an email, ask Jill at jillonmoney.com. And while you are kind of finagling around online, hop onto the website, jillonmoney.com. You can sign up for our free weekly newsletter. All right, we'll see you next week. Thanks for listening.